Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today in the EIA show, we're going to really look at what's happened with Colonial, what are some of the residual impacts that we've continued to see, and then how is that going to reverberate through the system. And we're going to break that up into obviously our normal three parts of section one, looking at the overview, just some of the summaries. Segment two is going to be the deeper dive into U.S. demand for refined products, what's happening, where are we in the reopening trade. And then in the last segment, we're going to go further into Asia and the global market. But in this week's show, we're going to focus a lot more on what's happening within Asia, given the fact that we've seen a big increase in exports. And how is that going to impact the market over the next few weeks as those continue to push into the market? So now we're just going to, kick off looking at the Colonial pipeline system. Just that we showed this last week. It's the same thing. Not much has changed. This is just looking at where everything goes from in terms of PADDIII into PADDIII. And it's important to appreciate, where the outages are, because you can see where the further away you are from the coast, that's where you're going to rely on, obviously, more of the pipeline. And given the issues that we continue to see of the shortage of truck drivers, the inability to get stuff from the racks or the blending areas into the retail market is where we continue to see some of these struggles. Everything is back up and running. There was some delay yesterday when one of the booking systems went down. That is now back on. It's just going to be that slow process of getting everything normalized, getting everyone comfortable with where it is, and then obviously getting it to the end user. Because right now there were very few actual racks and blending locations that were out of product. It's just more on the retail side, which again is going to skew some of the data in the near term, which we'll talk about. This was another one that we just wanted to look at. It's still the case where we still have a big increase in flow coming into the Americas from Europe. Some of that has started to deviate into the Caribbean, and so far we have 2 tankers that have moved into a different location, or at least started flagging something different. But so far we still have a very robust flow of product from Europe into the Americas that will continue to move over, specifically, obviously, PADDIII. When we look at the GasBuddy fuel outages, this is just kind of showing you that backdrop of where we peaked. You can see that we peaked on the 13th, and then we've kind of steadily started to come back down. Now, obviously, this is a massive pull forward of demand. So now that people have pulled forward demand, there's going to be a little bit of that lag, especially as we start to see some of this refuel, because when we always talk about the structure, so what is the flow? So you go from the refiner that makes the gasoline, which then puts it into a storage tank. Then it goes from the storage tank into a pipeline, into that pipeline to the blending locations, from the blending locations into a truck, from the truck to the retail. So where we are in that process is going to impact how does that flow go, where does all of this move, and this is why you're going to continue to see some of this pressure, which on the GasBuddy side, they say lower demand earlier in the week makes it easier to catch up without seeing those outages. So right now so just to give you an idea of where we are right now, for the 6th straight day, gasoline demand is down week over week due to the Colonial pipeline related demand shifts. According to GasBuddy, Tuesday, U.S. gasoline demand was down 16%, which right now, week to date, Sunday to Tuesday, is down 17.4%. And again, that's because you saw people rushing to fill up. Now you're going to have to see that, refill itself. And this is going to continue. So by the time we get into Memorial Day, we should be back to normal. But again, how active are people going to drive around? If they're concerned about fuel, this could change some plans, and we'll actually talk about that in segment 2. This is looking at the hierarchy of where those flows are. So obviously PADDIII had a massive build of 5.7 million, just because you can't get it to the market. And then when you look at PADDII, you had a drop of 4.58 million. So net, you had a decline of 1.96. This will start to adjust, especially because you have a slowdown in that pull through within PADDII. and you're going to start to see more product get pushed through on PADDIII. The difference is we do have a big shift in the U.S. Trying to create even more gasoline, getting back to those runs, which we'll talk about more on segment 2. But on the gasoline side, we're still only 5 million below the 5-year average. And when you look at PADDIII, we're actually 8.3 million above the 5-year average. Blending components had that decline of 1.63 million, which is only 2.8 million below the 5-year average. And then when you turn to imports, you can see that imports were up 146,000. 188,000 came into PADDIII, which when we think about what percentage that is, or on the actual numbers themselves, 247,000 barrels a day above the 5-year average was coming into PADDIII. And just based on what's behind this push, we're going to see a very consistent flow over the next 3 to 4 weeks for the most part to see this continuous flow into our market. Which, if you think about where demand is, which remains soft, and then you have the refiners targeting more gasoline. Now you have more gasoline coming into the market. This is going to create this weird dynamic where even if we do get a sustainable move in demand, there's going to be more than enough product to really meet that growth. Just putting it into perspective, when we look at the gasoline at the PADDIII, we're at a 2021 high, which is seasonally adjusted at a all-time high for this time of year. And this is including 2020 to give you an idea of how big we are right now in PADDIII. But when you look at where things are going, so at least 2 tankers hauling gasoline from Europe to the U.S. were diverted to the Bahamas. Following the restart of Colonial. So we'll start to see some of those shifts. It's always a matter of margin. Where are you finding your best margin? And right now, you're going to have some of it peeling off, but a lot of it will continue into the U.S. markets. And this is why, when you look at PADDIII, we're at a new all-time low, seasonally adjusted, and then at the lowest point for 2021. But we're not at the lowest ever. It's just going to be a matter of timing, because when you look at PADDIII, we typically have builds up until about the end of May, which obviously is Memorial Day, when you start to get those drawdowns through summer. So this is going to be something to watch of how quickly does PADDIII refill, and do we see that some of that balancing between PADDIII and PADDIII, which is the answer is yes. The question will just always be how fast. So then when you turn to the net gasoline inventory, you can see that there wasn't too much of a change. We're still within the cloud here, obviously moving away from the 5-year average, but we expect that to pivot higher, especially as we start to get towards that normal market, because we will continue to see some of this inventory pulling through. As the rack essentially signals, look, we need more because it's going to the retail, and that will keep some of this product moving through the system. Now, when you look at what's happened in the curve, you can see that we've had some pressure to the front month. It has shifted the whole curve down. And the reason why this is starting to become, the whole curve is moving is the Iranian deal. If the Iranian deal comes through, what does that mean for numbers? What does that mean for pull? The additional barrels. And again, that is putting pressure on the overall curve. Clearly, we're still over 55 going into the end of 2023. So it's not like there's a huge shift. We're still above 50 throughout the whole curve that was struck, at about 11:45. So you can see that we're right within this comfort level. What we've been saying is that the front months are still too high. Not to say that the curve is wrong, or not to say that it's predictive either, but it's just the front month seeing some of that adjustment, just because there is a lot of crude that remains in the market that we want to start to see get absorbed. And the reason why is when we start looking at COVID itself, Asia Pacific has started to come down. The European Union continues to trend better, which is why when we look at France, when we look at Germany, Italy, all trending in the right direction, which is leading to where we're seeing some of this increase of activity. And that's one of the better parts of kind of where this recovery sits. Is Europe is starting to get back to normal. The problem right now is, as Europe is getting back to normal, Asia is getting much worse. But when we look at what is getting worse in Asia, you have to put that into context because India is getting better. They're in a pretty steep lockdown right now. And it's more of a regional side, but about 72% on the stringency index is right there. So you're seeing that pressure. South Korea is starting to pick up a little bit. Japan is remaining elevated. And then when we look at Taiwan and some of the others, you're starting to see some of that pressure upwards. The one that we've also talked about is Seychelles. So Seychelles was the most vaccinated country in the world, utilizing the Chinese vaccine, and they're actually getting a big resurgence of the of specific variant. I think it's the Indian variant right now. And the question is does this mean that the Chinese vaccine isn't as effective, maybe not as effective against that variant? And this is going to lead to some of that unknown that we'll have to watch to see if Asia continues to get worse as this the Indian variant moves throughout the system. So when we turn to the U.S., you can see that we had on a commercial side, we had a build of 1.32 million barrels. On a net level, once you factor in the SPR, we actually had a draw of 580,000 barrels just because we continue to see crude moving out of the Strategic Petroleum Reserve into the market. So that's where we always look at what is happening with commercial as well as when you factor in the SPR. Crude production is based on the calculations is about flattish. We have it at about 11.1 on its way up. But again, it's just going to be a matter of timing based on the calculation that's being used. So when we look at the overall market from a crude level, we're 16.9 million below the 5-year average, but we're still, it depends on what 5 years you're using, which is why we always go back and forth between, is it a good metric? Is there a metric that is better? But this is just something that the market's looking at. So we're just going to keep, highlighting this is where we're seeing things. Cushing had a small draw of 140,000 barrels, which brings us down 9.4 million below the 5-year. But then PADDIII, we continue to see those builds. And now they're 17.5 million over the 5-year average. So when you look at the activity side, PADDIII continues to draw down with PADDII and PADDIII fairly stable at this point. PADDIII had a draw of 2.45 million, but that's also going to get backfilled. It's just a matter of how quickly does it get backfilled? Where does that come into the system? And those are going to be some of those timing delays that we're always talking about. And the timing delays when we look at stockpiles. So as of last week, stockpiles onshore rose 7.8 million to 662 million onshore. You can see the pivot happened on the total. And what was the big driver? Not surprising, it was Asia. When you look at Japan, Shandong, and we'll talk about this in segment 3, we've actually had some Japan coming in and China coming in and buying up some of these spot cargoes that were trading at discounts, starting to clear some of that market. And we'll talk about what does that mean, because it's good for some grades. Some grades have tightened a bit, especially ESPO. CPC is still slightly better, but on a West African side, there's still a lot of struggle. And that's where you're seeing this bifurcation in the market in terms of where are some of these flows coming from. And that's going to be something to look at. And then when we talk about west of Suez, US ARA, as we said last week, was kind of flattish because it offset just based on what happened in Europe versus what happened in the US. And this is when we start looking at what is going to continue over the next few weeks. And we think that you're going to continue to see land storage grow, specifically east of Suez, which is going to keep us elevated on a global storage level. Then when we turn to the fuel demand, China has bounced back up. This is one that we think is going to bounce between, down 90, at 90% to 100%. We don't think you're going to get another surge higher. They have some small growth of COVID. Not to say it's large, but again, it's going to be enough to quarantine some specific locations, and that will just kind of keep things here. Not to say it's going to move up or down. Europe had a nice little pop and is starting to roll over a bit, not rolling over back down. It's just we think it's going to find this range that is going to stay in right here. As you can see with North America, something very similar. North America, when we look at road fuel demand recovery, this is pulling in TomTom data. TomTom data is going to get a little bit worse as people do less following following what happened in the with Colonial and how that locked things down. Sorry, I thought I was going to sneeze, and then I was able to hold that one back. But rest of Asia is getting worse, and not based on what we're seeing right now, we think it's going to flatline here. So when you look at this chart as you go forward over the next few weeks, we just think that it's going to go sideways. And that's, again, just kind of showing that we're hitting this plateau, especially when you start looking at rest of Asia, because you will start to see some balancing act at this point. Same with North America as the Colonial headwinds start to abate. Then when we look at crude oil inventory, excluding the SPR, here's again what we were kind of saying, where it's just going to be steady state. We don't see big builds. We don't really see big draws. It's just going to be this rate of change of flat. And it's going to be a mixture of, we do have more production in the US. We still have less imports. We still have refiners that are operating, a little bit below where they should be right now. And again, this is going to keep us just essentially a steady balance of crude in storage. And this is where when we're talking about that flatlining, we had those drawdowns, and now this is just looking at PADDIII. You can see kind of this flat move where the rate of change, it's up, and it'll stay elevated, but again, it's just going to go sideways at this point. And then the same can be said about Cushing, where we've been saying that it's just going to be this sideways move, because you're going to have this balancing between what's happening in PADDIII, what's being pulled down from Cushing, what's happening with exports. And while exports had a big increase, that's something that, again, some of that makeup trade that we were talking about, trying to push some of this crude that's sitting in PADDIII back into the market. We did get another increase in exports into Europe, which we'll talk about. That'll be supportive, but it still keeps us within that comfort range of 2.6 to 2.8 million. Going into the market, we came in at about 3.12 a day. So again, that balancing act is going to be there in general. And when we look at imports into the U.S., you can see that we did have a big increase of 923,000 barrels a day, which against the 5-year is still down 843,000 barrels. And we saw some of the recoveries that we were expecting, especially into PADDIII, as they try to make up for Colonial. They need more oil, so that's going to pull some more through. And then when you look at PADDII and III, those were areas that we expected to see an increase, and especially PADDII. Now, PADDII and PADDIII, we think, will remain elevated overall. It's just going to be a matter of how quickly. And then PADDII, just given where gasoline storage is right now, they have that spare capacity to continue to keep moving some of this product, especially oil, into the system. So we think that you'll see imports stay fairly elevated versus a year over year, a week over week. But again, not so much against the 5 years, and 6.4 is going to be hard to maintain because, again, those timing delays, but we will see this stay elevated, especially as we have more activity coming to the system. Now, on the runs level, we had a small increase of 0.2. It came in at 86.3%. Again, 95,000 additional barrels. It was really driven by PADDII, increasing by 73,000. We expect PADDII to remain elevated, and then PADDII is actually struggling a bit right now in terms of some slowdown, some increases. So here we think PADDIII is going to be fairly flat. PADDII will see some of this increase, so we will get a small level up, but again, nothing really major to pull through additional crude. Then when we look at fuel usage in Europe, just to kind of give you an idea of where things are going. In Europe, France is down at negative 3.8% versus last week of negative 9.6%, the strongest since August. Spain is at negative 4.5% versus 19.2% last week, strongest since COVID started. And Italy is at 12.7% versus 13.8%. So we're starting to see some from, and obviously this is all against 2019. So toll road use was down 7% last week on 2019 levels, just to give you an idea across the average of all three. So we are starting to get, again, that movement happening But this big step up is already being reflected, because when you look at, if you go, remember the slide that we just showed on road fuel, you had that spike and now you're coming down a bit. And that's, again, trying to balance that balancing act that we're seeing across the board. And even though we're getting more activity, there's still a lot of gasoline in storage in Europe. So even though we're getting more activity, we're still going to see flows coming into the US, because, implied demand is there just based on where things are right now. So when we look at gasoline, as we said last week, we expected a big spike higher. We got it here. It went up 424,000 barrels to 9.2 from 8.8. But then we had some flat to down numbers in disti. Distillate was only up 90,000 barrels a day. Jet was down 96,000. And residual, which kind of bounces around, which it was up 113,000, but that will reverse lower. When we look against the 5-year average, it's not surprising to see gasoline up. Again, this is a calculated number, and you had a huge surge. We saw lines, we saw obviously the outages. So that's pulling forward some of that demand. The question will be, how much of a step down do we get this week? And then when do we start to see some normalization, which is why we always talk about, and we start out with the 4-week rolling average in the next segment. So distillate is one that we kind of expected to see a little bit of an increase. And now, here we are. We think it'll stay elevated. Again, the question is always going to be how elevated. U.S. imports of European gasoline edged lower in the week through May 13th, which has now started to reverse a bit higher. And again, it's not that we're exploding up, because transatlantic gasoline arrivals in the U.S. dropped to 459,000 during this reporting period, versus 477,000. But again, still year to date, it keeps getting pulled higher, and we have more behind it, just because we're getting, like, Georgia received some diesel. We actually have more diesel coming in. May loading shipments of clean fuels from Asia to Americas surged to 335,000 tons from 175,000 tons a week earlier. So if you remember, we had 455,000 tons for April. Now we're back to 335,000 tons. And there's going to be more behind it, because we're going to get just additional flow. And this is going to come into PADDIII. Some of it may come into PADDIII, but realistically, most, if not all of it, is going to come right into the PADDIII or the Pacific coast. Oil floating storage came down. Again, we did get those imports, which is pulling stuff off the water. Based on what we're seeing, again, it's just going to be, it's not going to come to the 5-year average. It's just the trend will be up. So we will be in the comeback within the bottom of that cloud. And here's where we're talking about with the imports. We expected it to come back within the bottom of that cloud. Here you can see it's right below it. When you look back to across 2021, we're back to the highs of the imports. We'll see that again continue to just trend higher at this point, but not anything crazy. It'll trend higher versus 2021, but still be at the very bottom of the cloud as we look over the last 5 years. And then when we turn to PADDIII, we were expecting a bounce, which was, if you look at the 5-year average, counter seasonal, and that's what we expected to see. And just given the shortages in PADDII, we expect the PADDIII to remain fairly active, and some of these imports to remain elevated. Again, along those that 5-year level. And then when we turn to the refinery utilization rates, as we were saying, we expected it to be flat to slightly down. Instead, it was slightly up, but still fairly flat. And if you look at the last 29 years, we typically get a pretty steady move up in terms of just run rates, and we're just not getting that level. Again, a mixture of obviously Colonial and then the underlying decline in demand overall, which is going to keep some of the refinery throughput fairly capped. And then, as we're getting into May 19th, and then as we turn forward, as we progress into Memorial Day weekend, we expect to see some gradual increases, getting much closer to 87% as we get towards the end of May, with the ability to get to about 89%, as we get into, let's say, the first 2 weeks of June. The question will be, can we get to our normal 95, 97% utilization rate? And under the current dynamics of demand, it's very unlikely. But again, these are things that we're always looking at to see the sensitivities, and if there's going to be that demand profile for additional product, which would mean additional runs.